Okay, I'm going to go on now to chapter 6, and this has some complexity that I wish I didn't have to go so fast, but I just really need to complete this makeup session that for Unit 2, which we weren't able to do because of the ice and cold. So the main idea of chapter 6 is the idea of understanding the features of bonds. Bonds, like stocks, are tradable securities and are very important for the portfolio, diversified portfolio of individual investors as well as corporations. Different qualities of bonds, the probability or risk that a lender may or borrower may not be able to repay determines the interest rates, that and the market for other similar securities, the length of the time frame before the lender, the borrower repays, and also the credit quality and collateral and other details involved. So we're going to look at the formula of what we need to do to be able to value bonds. Now, bonds, unlike stocks, you buy them and you have no idea for certain what they're going to be worth in the future. They could be worth more than you pay for them, or they could be worth less. And in general, they will last the rest of your lifetime unless the company goes through a merger or acquisition. Bonds, on the other hand, always have a specific beginning day and an end. It might be a 10-year bond, a 5-year bond, a 20-year bond, but it starts on a specific day and it will mature and pay out the last interest and the full principal. So if you are the bond holder for the entire time frame, let's say it's a 10-year bond, in January 2014, you put $1,000 into this bond, and in January 2024, 10 years from now, you get your $1,000 back and the interest for the last period. Usually it's a semi-annual or 6 months. So I know what the bond is going to be worth 10 years from now. But between today and 10 years from now, it could be worth different amounts of money on the market if I choose to sell the bond. And so that's part of our calculation in this chapter, is what is the yield to maturity? How do we calculate the yield on a bond? The bond has what's called par value. That's the face value or par value, PAR, of this bond. A $1,000 bond is worth $1,000 at maturity. $1,000 was put in, and $1,000 will be paid out in the future at maturity, unless it's been called, but usually that's the time frame. The coupon is the fixed interest rate that the borrower has agreed to pay. 5%, 6%, 7%, whatever it could be. It always will be 5 to 6%. So if it's a 6% coupon and it's $1,000 face value, then that means that $60 will be paid every year, 6% of $1,000. And if it's semi-annual payments, then $30 will be paid every 6 months. Together, that's $60 a year. The company will never pay more than $60, will never pay less. They pay 1 nickel less than $60 a year until maturity. Anything less than the full interest payment is a default and triggers all kinds of bad things. So they want to avoid that. Now, the yield, however, is different. The yield is the market price of the bond over the coupon, or the coupon over the market price. So we're going to be looking at that and making some calculations about that. I'm going to go quickly here, if this is worth reading, but I'm trying to focus just on the quiz questions for you. So let's look at Chapter 6, Problem 4, which is on page 196. And it says, the Timberlake Jackson Wardrobe Company has 8% coupon bonds on the market with 9 years left to maturity. The bonds make annual payments. If the bond currently sells for $1,047.50, what is its yield to maturity? And the question being asked you is, what is the total return of this bond? Now, I said that the bond price can change from the starting point to the ending point. It can go above 1,000, it can go below 1,000, depending on many things like what's the interest rate being offered by other bonds of similar credit quality and many other variables, which I'm not going to get into. But the price will change if the owner decides to sell. In this case, this bond has a premium. It's worth more than $1,000. It's worth $1,047.50. So $47.50 is the premium. It could also have a discount, meaning it's worth less than $1,000 by some amount, and there's different reasons for that. Now, here we're asked, what is the yield to maturity? And if you look on page 170, 171. It's some helpful ideas on how to use the calculator in order to come up with the yield to maturity. What we want to know is, in this case, we're going to be losing some money from the interest rate. So we know that there's a cost to be paid for holding this bond. If I buy it at $147.50, $1,047.50, and hold it to maturity, which in this case is another 9 years, I know for certain that I will not make 8%. It's not possible, because I have now paid a premium for this bond, the $47.50. So I know that the yield to maturity is going to be less than 8%. How much less? It depends on how much of a premium I'm going to buy. So what I'm looking then is I'm trying to find out the interest rate per year based on the price. The price is going to be worth in the future. In this case, previous to now, we've been talking about estimates of what things will be worth in the future. In this case, I know exactly what it'll be worth in the future, 9 years in the future. $1,000. At maturity, it'll be worth par or face value. I know exactly how much it's worth on the marketplace today, $1,047.50. I know exactly what the term is. This bond will cease to exist after 9 more years. It's not going to, unlike stocks and other things which could linger and go on forever, this bond goes away when it matures. So I know the future value, I know the present value, I know the time frame, I know the payment, which is, it's an 8% bond, which means it has $80 annual coupons. 8% of 1,000 is $80. So again, we're trying to figure out what do we need to know? We want to know the interest rate, which will be the yield to maturity in this case. And we're being given 4 variables this time. We're solving for the 5th one. So since you know what the 5th one is, I just told you, you're solving for the other 4. And put those in. Something goes next to N, the first button, something, the I/Y, that's what we're solving for, so you leave that blank. Something is the present value. Again, that would be negative. We have a payment. That's positive. And we have future value. Put in those 4 things, solve for the 5th one. Next question. This is quiz question 7, which is chapter 5. No, wait, take that back. Quiz question 9, which is chapter 6, question 12. Right? I get them all? Yeah. So, okay, so chapter 6, problem 12. Nominal versus real returns. Say you own an asset that had a total return last year of 13%. If the inflation rate last year was 4.1%, what was your real return? Now, what they're really asking you to do is use what's called the Fisher equation, and that is found on page 188 at the bottom of the page. The Fisher effect, it's named after an economist named Irving Fisher, who was one of the primary leading economists of the 20th century, which you've never heard of him, but he was a big shot and very influential, and one of his formulas is right here. So you look in the box there on page 189 and notice how much this is similar to our question. It's to understand the difference between the influence of real return and nominal return. Nominal return is the numerical return you get. If I get 10% return, for example, on an investment of some kind, and inflation is 4%, my nominal return was 10%. However, my real return, because the purchasing power of money has devalued my currency by 4% because of inflation that year, I have my real return is 6%. Nominal return is 10. Real return after inflation is 6. So the Fisher effect is a formula to help calculate that. And if you look at the example there, if investors require 10% rate of return, real rate, and the inflation rate is 8%, what must the approximate nominal rate be? The nominal rate, remember, is the before the gross amount, in other words. So you just follow that thing. We know that we need a 10% real rate, and we have an 8% rate of inflation, and the calculation says that we need a nominal rate close to 19% in this example on page 189. Use that formula in answering the question, quiz question 9, which is chapter 6 question or problem 12. Now let's look at the last one, quiz question 10, which is chapter 6 problem 18, bond yields. PK Software has 8% coupon bonds on the market with 18 years to maturity. The bonds make semi-annual payments and currently sell for 93% of par. What is the current yield on PK's bonds, the yield to maturity, the effective annual yield? Now let's see, so you've got 3 problems you're solving for here, but one leads to the next as you do them. What's the current yield? What's the yield to maturity? What's the effective annual yield? I'll help you with the first 2, and you can do the last one yourself. The current yield is very simply the current yield on a bond. Let's say the bond is now, the price of it is $900. $900 is the market price. It's a $1,000 bond at maturity, but apparently we're years away from maturity, and so right now the bond is selling to other investors who are involved at $900. And the coupon, let's say the coupon is 9%. 9% is what people who bought it at $1,000 or lent it out at $1,000 are receiving on an annual basis, or $90. 9% of $1,000. But now I can buy the same $1,000 bond for $900. So what's my current yield? Well, the current yield is going to be higher than 9%, because I don't have to give $1,000, I can give $900 to get that money. And so that's going to give me a 10%. 9 over 900, in my simple math here, is 10%. I'm getting a 10% yield on this bond. Do that here, except you'll notice that the textbook writers are playing with your mind, and they're not telling you what the current market price is. They're saying that the current market price is 93% of par, or face value is another term, means the same thing. Well, it didn't even say what the bond is worth. Assume the bond is worth $1,000. So if it's selling for 93%, that's $930. The denominator, and then you also know what the coupon is. It says it right there. Second question is, what's the yield to maturity? The yield to maturity is just like we just did in quiz question 9, I think, or 8. Quiz question 8 is that you're being given the number of periods, the present value, the payment, and the future value. But notice that this is they're playing with your head here, because you're going to have to adjust something. It says the interest rate is 8% coupon. That's the annual coupon. $80 in here. $80 is what you, but it's a semi-annual coupon. So you don't get $80 once a year, you get $40 twice a year, which is $80 for the whole year. Therefore, the number of periods is not 18 years, since we're being paid twice a year. The number of periods is twice as many, and the payments are half as much as the annual amount. So change that. When you put that in, N, what's the right number of periods? It's not 18, but you figure out what it should be. We're solving for the yield of maturity, so that one is blank. The present value is the 93% of par, which I just told you how to figure that out. The payment then is not the annual, but the semi-annual amount. The future value is $1,000. Every bond is worth its face value, in this case $1,000, at maturity. And so that will give you, and then you compute I/Y, and you'll have the yield of maturity. And should fit what you have there in the multiple choice on your quiz. It also asks you to come up with the effective annual yield, which refers back to the very end of chapter 5. And you can do that very simply, I think, just by following the example in the book. So these are hopefully helpful things for chapters 4, 5, and 6. Go back over and replay any portion of my video, and if necessary, give me a call or shoot me an email. If you get stuck, probably you need to just make a different adjustment to the calculator. Oh, and I should say that when you we changed the beginning to end of term for quiz questions for quiz questions 6 and 7, I think. And then for 8, 9, and 10, you go back to beginning of term. And you do the same thing, is that you, to change the term, you press second, and then the yellow button. Then you press payment or begin. If it's still end, it'll say END on the left side, not in the upper right corner. Then you press second again, and you press enter, which is the same as saying set, and it switches it to BGN. Now it'll say BGN, beginning of period, in the upper right corner. End is blank all the time. BGN, if it's correctly set up, will be in the upper right corner. Very tiny print. And then just zero it out, and the BGN will stay there if that's what the calculator is using. So you'll need that BGN, or beginning of period, for quiz questions 1 through 5 and 8, 9, and 10, and end of period for quiz questions 6 and 7. Any other issues that come up, please shoot me an email or a phone call. I'll be glad to try and help. We're not going to spend a lot of time doing a review when we meet next Monday, because I need to then go on to the next unit, which also has some fun things, but be sure and bring your calculator because you'll need it for those exercises as well. See you then, and stay warm.